And in our top business story, Air Arabia has officially announced its new additional hub in Ras Al Khaimah. At a press briefing, His Excellency Engineer Sheikh Salim bin Sultan Al Qasimi, Chairman of the Department of Civil Aviation Ras Al Khaimah, announced the partnership they entered with Air Arabia in February this year. He says this will provide Ras Al Khaimah residents access to more destinations and boost tourism in the emirate. The budget airline CEO Adil Ali says from the 6th of May, the low-cost carrier will be directing flights to 8 routes from Rak International Airport. According to Ali, this is proof as well of the growing demand in Ras Al Khaimah. 2 newly acquired Airbus A320 aircraft will initially be based at Ras Al Khaimah International Airport to service regular routes to Saudi, Egypt, Oman, Pakistan and India.
This partnership and strategic collaboration between the Department of Civil Aviation Ras Al Khaimah and Air Arabia will impact the Ras Al Khaimah International Airport in a positive way. The number of flights they are operating to 8 destinations at the beginning and their future ambitious plans will require Rak Airport to expand its facilities. But as we speak today, and my colleague Adil Ali, he said the Ras Al Khaimah International Airport is the ideal model of Air Arabia requirements to start their operation. And once we see the number triggers, we will definitely, in coordination with them, reconsider the expansion of both the airline and the airport.
I think historically, airlines have brought benefits to any airport, any country that they go to. It drives the economical wheels, and therefore, when you set up a hub here, just like any other airport, you need people to work. More people will come to stay in the hotels, and when they stay in the hotel, then they go out and spend money shopping. And therefore, you need to have more shops, more people, more restaurants, and more drivers and cars and taxis. So it's a very big economical wheel that we've witnessed that in our hub in Sharjah. We've seen it happening with other airlines in Dubai, in Abu Dhabi, in Qatar. So it will continue to be growing for the public and interest the financial and economic sectors.
Etihad Airways has announced the signing of a code-share agreement with Fiji Airways, which will allow the sale of reciprocal tickets between them. This agreement will allow the sales to and from 12 cities in Europe, 17 cities in the Middle East, 5 cities in Africa, 5 cities in North America, 29 cities in Asia and 3 cities in Australia to and from Fiji. The agreement comes into place with immediate effect and is the starting point of further negotiations between the two airlines. The announcement comes following the record first quarter cargo and passenger growth of 27% for the national carrier. Etihad said its code-share and equity partnerships delivered 678,000 passengers onto Etihad Airways flights in Q1, which is 25% higher than the same period last year, adding that the revenue from code-share and equity partners increased by 23% to $223 million, representing 22% of total revenue for the quarter. Dubai's residential sector has seen rents surge by an average of 22% year-on-year, with apartments registering an increase of 29%, whilst villas rentals have grown by 15%, according to the latest Dubai market view by global property advisor CBRE. According to the CBRE report, quarter-on-quarter rental growth has been more marginal at around 2.8%, with apartments rising by 3.0% and villas by 2.6%. The strongest sub-markets for apartments were Sports City, downtown Dubai, JBR, International City and Dubai Silicon Oasis. For villas, the best-performing markets were Al Warga and Springs. The residential development pipeline is again starting to swell, with an increasing number of new projects being launched. During 2014, close to 17,000 new units are expected to be completed, with the majority of these set to be delivered in secondary locations such as Dubai Land, Jumeirah Village Circle and Silicon Oasis. Over the next 4 years, roughly 65,000 new units are penned for completion, with 83% of these apartments and villas and townhouses comprising the balance. According to Matt Green, the head of research and consultancy at CBRE Middle East, the rising cost of living in the emirate is now starting to become a very real concern for many residents, with rentals having risen by an average of 45% during the past 2 years.
Dubai is obviously becoming an increasingly expensive place to live. We had 3% rental growth this quarter overall, and you mean 22% growth on an annualized basis. Now, I don't think these rates are going to be sustainable in the long term. So it is interesting to note that this quarter that the growth was more marginal compared to what we've seen over the past 24 months actually. So hopefully that's an indication that we are starting to see these growth levels slow down a little bit more towards something which is actually a bit more sustainable in the longer term. And obviously, I mean, where people are moving to at the moment is very much kind of dictated by this flight to affordability. It is something that we're seeing not just in Dubai, but also in terms of movement towards the Northern Emirates and Sharjah in some cases as well.
Additionally, according to the report, while office rentals in Dubai continue to rise, with average prime CBD rentals up 3% quarter-on-quarter and 21% year-on-year, as the Emirates business environment continues to improve, supply of leasable premises suitable for the requirements of larger companies continues to be an issue.
The market remains very fragmented, so we have a very high headline vacancy rate, but in certain sub-markets around about the CBD, around about TCOM A and B, Dubai Media City, Internet City, and also within certain parts of DIFC, there is actually quite limited supply of good quality offices which are going to be suitable for the larger space occupiers. So if you're a corporate tenant and you're looking to find several contiguous floors within a good quality, a single-owned building within one of these locations, then you will actually now have very limited options available to you. This has kind of come about because of the overdevelopment of fractional strata spaces during the last real estate cycle. So a lot of the office product which you are seeing delivered now into the market is actually strata space, which is already been sold off to investors and kind of split horizontally and vertically, which makes it very difficult to actually occupy from a corporate perspective.